In this module, we have learned about how central bank manages the natural equilibrium of the economy. As we know, equilibrium is a situation when demand in the economy meets with the supply. Whenever there is disequilibrium in the economy, central bank manages the money supply to bring back the economy to its natural equilibrium. Let's make things a little simpler. Consider central banker to economy to be like a doctor to our body. As we know, there is a natural order and equilibrium of body, and whenever the equilibrium gets disturbed because of some external reasons, flu virus from other countries, remember swan flu, or internal reasons, it gets reflected as high fever or body ache or some other form. The doctor then prescribes some medicines which get our body back to normal. Same is the case with economy. There is a natural equilibrium at which our economy stabilizes, which is around the meeting point of aggregate demand and aggregate supply. This equilibrium is the point where the self-interest of all the participants meet. But sometimes, because of some external reasons, that is, virus from American financial system, mortgage market, or some internal reasons, say flood or a drought or corporate failures or structural issues, this equilibrium gets disturbed, which gets reflected in prices, output and unemployment. The doctor then diagnoses problems and then takes corrective actions to heal the diseases and bring back the equilibrium of the economy. Following are the learning objectives of this module. Understanding natural equilibrium of economy. Sneezes and infection of American financial system and high fever in global economy. Understanding the impact of financial crisis flu on Indian economy's health through trade, finance and confidence channel. Impact of financial crisis on real sector. Stance of monetary policy. Restoring equilibrium in the financial market by increasing money supply. Expected restoration of equilibrium in goods and services market from recessionary to normal. Restoration of equilibrium in forex market by selling dollars. Impact of treatment by RBI on the health of economy. Signs of perennial disease, that is, inflation. The policy stance. Restoring equilibrium in the financial market by decreasing money supply. Expected changes in goods and services market equilibrium in 2011-2012 from inflationary to normal. Broadly, there are 4 markets that operate simultaneously in the market, and ideally all of them have to be in equilibrium for economy to work efficiently. However, it's rarely that economy is in that kind of situation. Aggregate demand and aggregate supply market. Capital market. Foreign exchange market and factors of production market. In our analysis, we would cover only the first 3 as they are more critical determinants of the economy. 2008-2010. Summary of the state of Indian economy and the monetary pills RBI carried out. In 2008-2009, first half, state of the economy business as usual, RBI fighting inflation. Inflation was high and AD growth also high. Inflation started touching 10% levels and all growth parameters up. The RBI stance. RBI has put in place a contractionary money policy to control inflation. In 2008-2009 second half, the economy state, the US-led subprime mortgage storm burst. Sudden flight of external capital away from India exchange rate disequilibrium. Trade went down suddenly. I&C reduced. Product and services market disequilibrium. Liquidity dried up suddenly. Inflation low. Money market disequilibrium. In result, stocks crash. BOP levels reduced. Rupee going down. CAD increased. AD or GDP reduced. Tinges of liquidity trap owing to confidence crisis and supply of money reduced. RBI stance. Reversed stand to infuse heavy liquidity through all possible monetary channels. Increase trade by confidence building. Prop up rupee. In 2009-2010, the economy state recovery phase starts. Product and services market started improving. Money market started easing. Exchange rate market started easing. And inflation continued to be low. In result, GDP increase, rupees started getting stronger, trade started picking up, interest rates remained low, and inflation remained low. The RBI stance. RBI maintained the expansionary monetary policy. In 2010-2011, the economy state moving back to business as usual. Inflation started showing its teeth again, owing partly to demand pull inflation. In result, inflation started touching 10% levels, all growth parameters up. The RBI stance was, RBI started reversing the money policy gradually to control inflation. To make our analysis more contextual and relevant to theory, we will be focusing on problems that Indian economy has faced in the financial years 2008-2009 and 2009-2010.